Welcome to Block Time. So today we're going to talk about cryptocurrency mining, and in particular, some of these large mining companies that are coming onto the public markets. And it's really exciting to see this. We've seen a number of companies list on the TSXV, on the Toronto Stock Exchange, and we're also starting to see some companies list in the US. While this is exciting, I'm also seeing some confusion in how these companies operate and how they make money. Now, one thing that's really important to understand is that cryptocurrency mining is a fixed dollar margin business. Now, what this means is that if the value of the underlying cryptocurrency that's being mined increases, it doesn't mean that the value of the mining company increases. Now, that may sound counterintuitive, but I'm going to explain why that is the case. Now, the important thing to understand is that the profitability of mining is related to the number of miners, or more technically, the amount of hash power that's being contributed to the network. And as the number of miners increases, the profitability per miner decreases, and vice versa. And the reason for this is because every time a block is formed on the blockchain, and this applies to almost all major cryptocurrencies that are being mined, each time a block is formed, the amount of cryptocurrency that's issued in that block is a fixed amount. It does not vary, certainly it does not vary according to how many miners there are on the network. So let's take an example. Let's say we're mining Ethereum, and just for numbers' sake, let's say Ethereum is at $1,000. And for the mining equipment that we have, we're mining 0.1 Ethereum per day, the equivalent of $100 per day. So $100 is our profit per day from our mining equipment. Now, if the price of Ethereum was to double to $2,000, it's easy to think that, well, now our 0.1 Ethereum is worth $200, so now we'll be making $200 a day, but this isn't the case. What we will actually see is, because the price of Ethereum has increased and there will be more miners on the network, rather than mining 0.1 Ethereum per day, we will be mining 0.05 Ethereum per day for that same $100. So why is this the case? Well, remember earlier we talked about profitability of mining being related to the number of miners on the network. Well, what we're actually going to see is, as that price of Ethereum increases, more miners are going to be joining the network. The hash power on the network will increase. And so the amount of money that we will make from mining using that very same equipment will decrease proportionally. And so we are still making that same $100 per day, but rather than making 0.1 Ethereum per day, we're making 0.05 Ethereum per day. Now, if the price of Ethereum drops, the inverse is also true. We will mine more Ethereum on our equipment, but that Ethereum will be worth less, and we will still find ourselves mining that same $100 per day. So why is it that miners are joining the network when the price increases? Well, profitability of mining is really down to two factors. It's the cost of the mining hardware, and it's the cost of the electricity. Mining is a very electricity-intensive process. For every miner out there, there is a threshold of profitability related to the cost of his hardware and the cost of the electricity when mining becomes profitable, and a threshold where it no longer becomes profitable. So what we see is, as the price of cryptocurrency increases, and obviously this is the case across all cryptocurrencies, more and more miners will turn on their equipment as it becomes more viable for them to mine. And in fact, a lot of these miners are using cloud computing, or using big data centers, big warehouses, and they will switch on their equipment when it's profitable to mine. And in fact, they'll actually switch their equipment between different cryptocurrencies to mine whichever is the most profitable at the time. So what this means is, over time, the margin for mining is always fixed. It's really a product of the cost of the hardware and the cost of electricity. As that margin increases, immediately more miners will be joining the network, and that margin will balance again. So once again, really important to remember that while the amount of cryptocurrency that each miner will make on a daily basis will fluctuate, the dollar value of that cryptocurrency will largely stay exactly the same. And we will not see a big fluctuation in the dollar revenue made on a daily basis by miners. So what some of these companies are doing to alleviate this is they are holding back a lot of the cryptocurrency that they're mining. And this means that they have cryptocurrency assets on their books. And this is a good idea because it means they will benefit from that appreciation. But we also have to bear in mind that it is quite a small part of their business. Most of the money that they're making has to go back into paying the operations, running a data center, paying for electricity, buying new hardware. So the amount of cryptocurrency they're able to keep back is relatively small, although it is really great that we are seeing that. So I'm really excited to see these companies coming to the market. But once again, I just want to make sure that people fully understand what the business model is and how these companies make money, and that mining is a fixed dollar margin business. So thanks for listening. If you have any questions or any comments or other topics you'd like me to cover, please comment below and I'll get to it in another video. Thank you.